Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Thursday, February 10th, 2022. It is 3:17 p.m. Eastern Time as I'm starting the video, so a little less than 45 minutes to go in the trading day, and I wanted to do a brief update on the market, but more so than an update, just I want to share some general trading tips or just considerations in your trading or investing. And what we're going to talk about is, proxies on how to trade the market. And we're going to talk about shorts today because that's where I'm at. But the same thing I'm going over 100% holds true on the inverse for bullish setups and rallies and the bullish leveraged ETFs or non-leveraged. And so the takeaway here is there are many ways to trade an index. You have obviously ETFs are very popular, easy, in and out, liquidity, everything you want. Then you have the leverage ETFs. You have typically with most indexes, you'll have a one or two time, or one time, two time, or three time leverage. A one time is non-leverage. That's IWM. We'll call it so. If I call it one time plus one, that means it's tracking the index without leverage. And then you have a negative. I think it's gosh, what is it? RWM, I think. And yeah, I think it's RWM in the small caps. Yeah, there it is. Without leverage, so you could buy that, and you're going short. And then, of course, you have your bullish and bearish. So we're going to talk on the bearish ones, TWM and TZA. And I'll get to QQQ in a second. The same thing holds true. I'm just going to use these two because, A, they're my preferred indexes to trade and have been recently. Sometimes I'll focus on the S&P if I'm, a heavy play on the financials or something that's underweighted in the NASDAQ 100. But and I'm going to talk on this right now. And really what I want to talk to you about is the use of leverage ETFs, pros and cons. And I'm going to start out here with just a quick explanation. On the site, right side of the chart, if you go to resources, click here, it brings you into the Sports Center, and there you have FAQs, frequently asked questions. So if you click on that, brings you here, and you have them by category. Here's ETF related questions, and this one right here talks about it. So what I'm just directing you there because I would encourage you to read this. And the reason for that is this is, I took an old post I made back in 2015, so this goes back years. And nothing has changed. For the most part, I find that the use of these leverage ETFs has been vilified. They even there was talks for a while and have been on and off over the years, take them off the market. Because if you don't know what you're doing, they are bad investments. Keyword investments. And so a lot of brokers have disclosures you have to click through even just to trade them. And they try to tell you they're only good for day trades, in and out trades. And that may or may not be the case. So the big part here is it's all about the math. It's simple mathematics. And you hear the word decay. I talk about it. Others do. And I will say that is that you don't want to hold these for an extended period of time. Obviously any ETF, especially if it's leverage against a trend, if you're going the wrong way, you're going to get stopped. Hopefully you have stops in place. But the other thing is, in a nutshell, these ETFs, not only does that leverage not hurt you or work against you if you hold these at the right time. And it could be a hold for days, weeks, sometimes even months, but usually up to a few weeks. And so if you get in these at the right time, and I think this is a timely conversation now, not only does that leverage not work against you, it actually works in your favor. In other words, you can go with a 2-time or a 3-time leverage ETF, whether it's long, meaning bullish, or inverse, meaning short, and you can and will, in the right conditions, vastly outperform the index plus the leverage that you were expecting. In other words, a 10% drop in the S&P 500 at the right time when a 3-time leveraged short ETF can put well beyond 30% in your pocket, not just 30% profit, not just 3 times a 10% drop. So we're going to talk about that, and I'll give you some real world examples. And the reason I'm doing it now, and I encourage you to go here, it's right here. This is it. It's mathematics. It's very simple. And this is where I think a lot of people don't, fail to understand. And so again, there is that element that gets more difficult. Okay, Randy, I see that. The math works. You explained it well. But how do I know when we're going to have a unidirectional versus a choppy trend? to get there. Because if I'm saying, let's say you have a security, we'll call it XYZ, and XYZ is at 100, right? And it's right here today, and you think it's going up here to 200. If it goes there in a relatively straight line, meaning up and up every day, pretty strong trend, then you should outperform with the leverage ETFs. If it takes a while, you go up, then you correct. You have a lot of especially the back and forth days, like a trading range. That's where the decay eats at you and works against you. And you still may make a profit. You may not, even if you get to your goal. Well, again, it all depends on how long that is, how far, how long it takes to get there. A lot of variables. But all right, let's look at the real world examples, and we'll start out with IWM. IWM, as I said earlier, I felt pretty strong about how objective that shorting up was. Look, a lot of work to be done, not to get excited yet, but so far so good. A pretty good rejection right off that 2850 level. Look at that candle. There's a long skinny body right there. That's the highs. So from the highs this morning, IWM has already dropped 2.8%. So they faded 100% and then some of the rally this morning. It's been quite the round turn. Gap way down. The buyers, as they can't resist, especially they still think the market's going to new highs. Dip buyers are doing what they've been doing. That's what they do. They buy dips. But when they start to get faded in their, slowly, a top in a market's a process, and it takes a while to realize what's been working for years all of a sudden isn't working. Now, again, I don't want to read too much into today's reversal because it is just noise within. This is par for the course lately. When volatility is high, you get these spikes, and so far you can see from the lows, the IWM rallied 3%, and then from there turned around and lost all that. That's a heck of a swing. And again, technically what happened today, there is some technical significance because we got rejected off a perfect back test of the resistance, or near perfect there, and now we have this trend line below we need to take out, and if so, that should help. And again, I already gave you the levels to watch. Now let's talk about what or how to trade the market, and I'm just going to go under the assumption that you're comfortable with shorting. Your views on the market align with mine, and you want to be short IWM or QQQ. And again, the same thing holds true in reverse if you're bullish and you want to go long, and these considerations. So here's where I'm at. If I am correct, and IWM is going down to the 170 level. If we're in the process at the point where I think we hit those first targets a week or two ago. We had and this is a counter trend bounce. And we're about to take soon, and I think it would be soon. Again, anything's possible. Maybe the market wants to do this till the Fed meeting's out of the way. Who knows? Let's just go under the assumption that we're getting close to that next leg down that I've been talking about. If it happens, it will most likely happen pretty fast because, number one, I have all the confidence in the world. Just looking at years and years of experience and studying charts before I was even doing this, you can go back, and the one constant that you have, it's pretty much a constant, is stocks tend to fall much faster than they rise. During bear markets and corrections, it is more than usual. It is the norm that in just a matter of weeks, months, sometimes years of gains are wiped out in a stock or in the market. So going off that, again, past history, that's all we can do with technical analysis. We're using past history. We study that and try to apply to current situations, look for similarities, chart patterns, all that, and then try to predict where stock prices are going. All right. And so I'm going to go under that assumption. And if that happens, then you're going to be better off in a leverage ETF, even if accounting for that leverage. What I mean by that is, let's say your position size. Everybody's different. I'll use a round number. Your position size, you want to short the indexes or IWM, you want to put 10,000 short. So you can either buy or go out and short IWM from your broker, $10,000, or you can buy our WM, that's the non-leverage inverse, $10,000 of that, or you could buy 5,000 of TWM because that's the 2 times short for the small caps, or you could buy 3,300, a third of 10,000, and put it into TZA. because now you have 300% leverage, effectively giving you a $10,000 net short exposure to the small caps. Okay, so we're going to just use that TZA example because that's the most extreme. To the best of my knowledge, there aren't any 4 or 5 time leverage ETFs out there. They just usually go up to 3 times. So what I'll do, and I've done this many times over the years on the site, we're just going to pick a period to illustrate that the outperformance when you get this. This is, you can see here, we started correcting. Remember, we had that false breakout back here in IWM, came down, hit the bottom of the range, had one last hurrah where the dip buyers did what they've been doing for over a year, stepping in and buying all pullbacks to 208.50 or roughly. They got that one last thrust up, right? So we're going to measure from there. From that point, things started going south and something changed and we broke that support. The drop, and you can see my pop-up box. I'm grabbing the high of the candle on January 4th right here. So the peak of that rally off that last bounce off the trading range down to the low. When we bottom, we hit that support slash target on the IWM weekly. And we bottomed out here on what was that date? The 28th, January 28th. And you can see from the pop-up box, if you look down on the very bottom, almost the bottom, a couple lines up in red on the right side, it says 17.19%. You can't see that. That's what it said over there. So that was a 17.19% drop. I'll be specific here. 17.19%. Let me make sure I have that here and did that right. Was it 17.19? Okay, I have to redo my scratch pad. I'll pull this up. I'm going to pull a calculator and multiply it real quick. Okay, I had put on my scratch pad. I had a couple fraction of a percentage off. So that's 17. What I've just said, 17 point. I stopped the video to record it. 17.19 times 3 is 51.57. So we'll call that 50. We'll even round it up, 52%, right? So you would think that, 17.19 times 3 equals 52. So in a perfect world, if TZA didn't have any decay, it should have given you about a 52% return. If it had that decay they talk about, it should have underperformed. But if the math works, and like it should have, because you can see here there were only a few green candles, and that's the other consideration. The green candles you had, they weren't very big. That's the greener they are, as I like to say, or the bigger the counter trend bounces each day. And again, this only applies on a daily time frame because that's all that matters. That formula I gave you on the FAQ page. It works, and the way this works is calculated end of day closes, not what happens. That 3% up and down during the day, insignificant. It's the daily closes that are going to work for or against you. And so when you do have a green candle, you want it minimal against the trend. So again, I measured, and there was a big one in there, and so I'm still including that, again, from top to bottom. So 52%, we need to do better than that, or match that, to just say that TZA is a good investment when you catch, if you get positioned at the right time. So here we are, January 4th, the low on that day, because TZA is an inverse, what will be the high of IWM. And you can see in the pop-up box to the left, the return instead of 52% was 70.76. So 71%. It blew it away, not even close. So, and I've done this again in the past, and I welcome you to do the same. You can go back. Doesn't matter which instrument. It's whether you're tracking the gold miners, Nugget and Dust, or QQQ. And we'll do one more example, then I'll let you go. QQQ. All right. So QQQ. What we need to do here, I would say, is go from this peak right here. That was January 12th, right? Because you can see from on January 12th, that's when things started to slide. Within 2 weeks, we dropped down about 14.4%. Yeah, no, we'll leave it there because that's a pretty much a unidirectional drop, 14.4%. So I'm going to go over to my calculator. 14.4 is times 3. Okay, that would be 43.2%. So 43% is the number we need to beat on SQQQ. going from the high on QQQ of January 12th down to the recent lows. And so we flip over to SQQQ and we go to January 12th, which would be right here. There's that coincides with that high in QQQ just before that big slide down into the recent lows. Grabbed it there, and we have a total return of 54.85%. So, and that was again over a short period of time. So there it is, guys. Trade as you want. Just keep that in mind. And look, if you go with a 3-time leverage, what I was saying before, you take a smaller position size to account for that leverage. But and then your stops, are going to be commensurate in percentage terms. You want to keep that in mind. And if you want to look at something else, that's a weekly chart there. Here we go. Here's the daily chart of SQQQ. Look at this. We have this nice now. Over time, you can't use these charts long term. You're just going to lose money if you just hold it, especially in a bull market. But over time, you get decay. But when you go to more recent price action, it's the charts are the closer you go in time, then the more accurate the levels are. In other words, I don't put much stock into a resistance level or a trend line that comes way back here on a 3-time leverage because of the decay. Over time, you'll get that decay. But more recently, you can see we had a nice resistance level, right? See that? At 35.10. That coincides with that topping pattern. Remember in the markets and SPY and QQQ, we had a lot of boom, 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 and there was that was a previous all-time high in the Qs right there. And so this is, remember, this is just like an upside down chart of QQQ. And so look at that. We back tested it the other day. We back tested it again yesterday and today at the lows, and we're starting to move off it. There's those recent candles that I said need to get taken out. And that'll really help the bearish case if we can take those out. And then, of course, the recent lows, it should be off to the races. So that's that. And so my takeaway is, I can't give individual investment advice, but I think I like the leverage ETFs at the right time. That's what I'm saying. I think that time is now coming up. I may be proven wrong. That's what stops are for. You can always get out. And what they do is they allow you to shorten to in accounts that you normally can't. Let's say you have a big 401k at your employer. That's where the bulk of your money is. They're not letting you, usually in mutual funds anyways. You can't go short. So you're either going to be in the market or maybe you go to cash. So maybe you have an IRA that you want to hedge against your 401k longs, and that's what you want to short in. Well, you can't short in IRAs. You can short futures. Most people don't know that. You got to get it set up with your broker. You can short futures contracts outright, but you can't short stocks or ETFs. But you can buy these leveraged inverse or leverage or non-leverage inverse ETFs. So you're effectively shorting. And whether it's an IRA or a non-IRA cash account, not margin, that's one benefit. And the other benefit is you're burning up less capital. If you've got 100,000 in an IRA or an account, and you wanted to be short the markets 30,000, let's say you wanted to be net short QQQ by $30,000, you only have to buy 10,000 SQQ, and that frees up $90,000 to do other things with, to diversify. So those are the benefits. And look, I don't work for the ETF companies. I'm not trying to sell any one ETF. I'm just showing you considerations. And again, I'm talking so much about it because everything I've ever come across read is vilifies these things. And so again, and they're a bad news to be in a sideways trading range. Let me tell you, when you didn't want to own TZA, even if you were right on where it was going right here. Let's just say hypothetically, way back here in the beginning of 2021, anywhere in here, you thought that IWM was going to go down to hit that 191 level, right? So you shorted and you bought TZA. Well, this is when it works against you. A lot of ups and downs, a lot of green and red candles, even day to day, green, red, it's just a back and forth. And you can do it yourself, see what it would have been, but you would have probably been better off just shorting IWM outright because you don't have that decay. But this, as I just showed you, this is where you want to be short. If we get that and it looks a lot like this, mostly down, you're going to want to be in TZA. If not, maybe let's say I'm right on where we go, but I'm wrong on when we get there. that's when you'd be better off shorting IWM or buying our RWM, the non-leveraged short version. Let's just say we grind around. The Fed's going to, everyone wants to wait and see what the Fed's going to do next month, and we grind around then, and then we spike up. Maybe we even go and test the old highs, but we never take out the previous high, and then we go on to hit my target. So I'm right on my price target call, but I'm wrong on how and when we're going to get there. So I just want to throw that out and let you decide if like I said, in the beginning of the video, I just want to talk about the pros and cons, because there's pros and cons to just about everything in trading. All right, I think you know what? Before I wrap it up, I'm going to get to the VIX. Somebody asked my thoughts on the VIX, and just anybody that's just catching up on things. This was T1 about 342 on QQQ, and that was hit a couple weeks ago. We bounced, so where we're at now is we had that impulsive leg down. It's just taking the form of potentially of a bear flag, and what we want to see, what we ideally, again, for it to be a bear flag, an impulsive breakdown, and if so, the measured target would be the flagpole added to the top of the flag, which should take us right down to about my second target. To put it in percentage terms, that's going to be a drop of about, from where we're at right now, about 16.5%. And again, if it plays out in typical bear flag fashion, the move out of the flagpole, out of the flag, is usually equally as impulsive. Usually mirrors, it comes close to mirroring, not perfectly, mirrors a move down, and so that would benefit being in SQQQ. Even being $10,000 in SQQQ should outperform 30,000 short on the Qs. But if we do this first and then get down to my target, you might have been better off on QQQ. So I'll let you decide. I told you I favor that. I think that'll happen, but we'll see. Okay, and a quick update on the VIX. I haven't updated it in a while. Somebody asked my thoughts. I said, well, look, I can tell you this. It's fallen to pretty decent support. I've had this line here for a while. The $20 level, created that line back in 2018. It's been a long-term support and resistance level. And so I know sometimes, you might not see what I'm seeing. Here's what I'll go through it real quick, why it is. All right, so you can see a lot of these candles focus mainly on where the largest cluster of both bodies and or shadows. Shadows are your skinny parts, bodies are the fat part. But here's a great example. It's really clear here. We punched through it, I'm sorry, there quite a bit, but each time we close the week, it's a weekly chart, back on or below that level. Here you can see it clearly. That was very good support at $20. Here it was resistance. This goes back now in 2019. You can see it here, and those few punches above were only shadows. That means intra-week we popped it only to close back right on or below that level. That's good resistance. Got above it for a little bit, traded above it, and then fell back below. So when I go back in time, and again, I'm rolling back now for, all the way into the early 2000s there, you can see there's periods where the VIX either breaks that support and then trades below it and it becomes resistance. And then in periods of corrections and bear markets, it gets above it and it acts as support. So resistance when it's below. There was the last bear market in 2007 to 2009. We were well above it. And then over time, the VIX will find a new floor. For a while there, the floor was $16. But there again, 20 was resistance. So I want to say that's where we're at now. And more recently, the floor became 16 again, while the market after COVID ran to new highs. But we're back at resistance now. So if the 20 level fails, and again, you want to see a solid weekly close, ideally a couple weekly closes below, then you'll probably go to the old floor 16 or even the floor before that, which was 1150 down here, right? That was an extreme. All right, and so on the daily chart, you can see roughly same level on the line. The blue line's at 1983 when I zoom in. That's where it was support, support, support back here. We popped through it. We've been trading through it somewhat. It's not the best defined support here on this daily chart, but it is support nonetheless. And so if we can rally from here, then we already hit this level a couple times. I've had this line there in advance as well, 37.61. We came close to it there. We hit it there right when the markets bottomed. I talked about that that day. I closed out that VXX I had, and as well as reversing from short to long in the equity positions. And it wasn't mere coincidence that the VIX hit resistance level I had at the very same time the stock market hit major support / price targets. You can see that level was here. There's a reaction high, a little bit through it there, another one there, a couple reactions there. And we already checked it once. So the VIX is in a near-term uptrend, making a series of higher highs so far and higher highs and higher lows. Just like the stock market right now is making a series of lower lows and higher highs. The stock market's pretty much an inverse of the VIX for the most part. So that's it. So where do we go from here? Well, here's where the VIX went during COVID. We could see that again. It's hard to say. It's really hard to call it because there's not many upper reaction points. But I would say this, that it makes sense if we take out the recent lows in the stock market. Even I think the VIX will probably take out that previous reaction high right there before we even take out the lows in the stock market. I think if we get anywhere close to the recent lows, you're going to get a lot of nervous longs. And what this also tells me is this is how big corrections end, big spike in the VIX. This shows me no fear, and that's one thing I've talked about it that's kept me on the more bearish side. Because despite that big drop, which was the biggest drop in the NASDAQ since COVID that we just had, no, it didn't scare them. It didn't put enough fear. It didn't drive enough shorts into the market. Didn't scare enough longs out. And I know that because I monitor things like the put-to-call ratios and the VIX and all that, which show me that, yeah, there was some fear. Some put buying for protection, all that, but not usually the amount that accompanies the end of a significant correction. So this plays into my analysis, and the way to trade it is TVIX or VXX. We already hit. Remember, that was the same day we hit my second target. I laid out these targets in advance, and so where do we go next? Again, this is kind of time it with, align these, I should say, with the equity markets, targets and support levels on the stock market. But I think we can make it up to probably T5 if we are going to hit my next downside targets. T2 on QQQ on the weekly chart and IWM, and that would be, if so, you're talking about 100% return, double your money in the VXX. So cuts both ways. It's a volatile little sucker. If they ramp the market up, and you'll see volatility just melt off. But I like the risk reward. If you're going to shoot for 100% return, you can give yourself a 20% stop loss, and you still have a excellent 5-to-1 risk reward ratio, where you're risking $1 to make 5. So I'll take that all day long. All right, guys, I'm going to wrap it up here, get the video out to you. This has been Randy Finney with the Right Side of the Chart. Have a great day.